I used to be in charge of a property and casualty insurance company, and the business model of insurance companies is actually very simple. We tried to take in more premium than we paid out in claims. And if we did that, we won. If we mispriced our product or more claims came in than we expected, then we'd lose. That's the basic business model of the insurance business. So the underwriters who reported to me would often come into my office and complain about claims coming in an area they didn't expect. And I would say to them, you're missing the whole point here. We're out of business unless we have claims. What do you think we're doing here? We're in the business of taking all of our insureds, adding up all their claims, and marking them up to make a profit basically off of their own claims. That's really the business model of the insurance business. And so if we didn't have those claims, we'd have nothing to mark up. We'd be out of business. Think about Lloyd's of London. Lloyd's of London has been around for almost 350 years. This is an accomplished business. The major business that they write is catastrophe insurance. They write insurance for hurricanes, earthquakes, etc. They absolutely hate it when there aren't catastrophes on a frequent basis. Why? Because the prices in the insurance business tend to go down when there aren't a large number of catastrophes. In fact, they'll often say, we need one big hurricane or one big earthquake somewhere to get this whole market straightened out. Now, what do they mean by that? What they mean is the pricing in the market has gotten so soft, so low because of the absence of catastrophes, people not thinking they need the insurance. Of course they do, but they don't think about it when there are long periods of time that go by where they don't have claims. And as a result, they are not willing to pay as much for the insurance. Prices get soft, and the profitability of those insurance syndicates at Lloyd's of London gets very, very thin. So what they need is a big loss. And when that happens, that straightens the market out and pricing gets normalized. And in fact, people will form insurance companies simply for the purpose of taking advantage of the profits that come into insurance companies almost invariably right after a large catastrophe because the prices have improved so much. Now, why am I going on about insurance when I'm supposed to be talking about options trading? And the answer is because options index options trading is in fact is at its essence a form of insurance. Portfolio managers want to protect their profits for a year, or they want to they're concerned about some fear in the market. They'll run out and buy puts. Well, who's selling them those puts? The participants in the markets, like ourselves, who are options income traders. So therefore, when there's a lot of fear in the market, that's actually when we can make a lot of money. Because while there can be many fears, frequently those fears are overblown and the pricing of the puts is too high, and therefore we can make a very nice profit by effectively selling those. And in fact, when there's not much fear, in a time like right now where volatility is at historic lows, it's tougher to make a buck because pricing is much lower. Just like in the insurance business, when a long period of time goes by and there are not catastrophes, the equivalent in the options business is where you don't have very much in the way of selling pressure before the buyers come back in and buy every dip that there is. And so that actually drives down the prices of options, which is almost the identical dynamic to prices being dropped in the insurance business. So next time you have a loss because of a flash crash or because of some kind of a temporary down move that pushes you out of your trade, I want you to think about the insurance business, and I want you to think about the fact that you would not be in business as a seller of put options, for example, if it weren't for these periodic surprise sell-offs that come around now and then. In fact, on our trading desk, we have often found that the worst months of the year are often followed by one of our best months of the year, and that is because prices got very high as a result of some giant movement in the marketplace. And as a result of those high prices, we were able to get paid much better for the puts we were selling. So if you get down about a loss, you're missing the whole point. It's those losses that basically are creating the business model that we're in, which is the selling of options. And since we are in that business model, it means that occasionally we're going to take a loss, and that loss actually is a positive for us long term because it's creating the demand for the very product that we're selling. So you've got to keep your losses in perspective. Don't miss the big picture. You're going to have losses. If you didn't have losses, you would never be able to make a profit selling options because there would be no demand for those options. And like in any other business, if there's no demand, prices drop, and it's tougher to make a buck. So keep your chin up. Every option strategy that you backtest, that you trade, is going to have losses in it. You can have spectacularly successful strategies that have the occasional loss. You can't bail out on it because you had a loss. Instead, you've got to right back in, just like those Lloyd's of underwriters, go right back in the next year after a catastrophe. They know this is a numbers game, and they will, if they stay in the game, keep putting their capital in. If they're pricing their product in an intelligent way, they're going to make a profit long term, and you can too.